Tony, what do you make of these changes, especially with the 10-year yield below 2% again today and debt in Europe increasingly negative?
Well, the nominations in Europe and the United States show the dependency that national governments have on central banks, because they don't have a solution of their own for slow economic growth, and they don't seem to have the political will or at least the ability to make much change in terms of national standard of living or productivity. The appointment of Christine Lagarde is very telling as well. It's a whatever else it takes moment, you could say, to draw on the comments from Mario Draghi 7 years ago this month, when he said he would do and the ECB would do whatever it takes. Clearly, the decision has a lot to do with the political navigation that the European Central Bank president must go through to do the things he or she wants to do. And it does show, again, the dependency that these national governments have on central banks to promote economic growth, to support the purchases of bonds that these governments will be issuing for a very long time.
Tracie, do you agree with that? What do you think of these proposed leadership changes?
Yes, certainly the proposed changes to the Federal Reserve would instill a couple of more dovish governors into the Federal Reserve, and that's exactly what the president is looking for, is more dovish stance from the Federal Reserve, because he believes that rates should be lower. And certainly with some of the broadly negative economic news that we're getting recently, markets are also starting to believe that the Federal Reserve will cut rates in July.
And Tracie, is that enough? The confidence that the markets have that we will get a Fed rate cut? You mentioned that, markets across the asset classes are sort of braced for some kind of a slowdown, but there's a sense out there that stocks can do okay because this will be somehow a preemptive easing move.
Sure. So we believe that markets have, by and large, priced in this good news around the potential for a Fed rate cut. And we caution that with the ADP numbers coming in lower today and the potential for another weak number on Friday, that investors may start pricing in a 50 basis point cut at the end of July, and we think that that would probably be a little too much, that the Federal Reserve is unlikely to cut by 50 but may cut by 25 basis points. So markets are probably pricing in more good news than we anticipate.
Tony, when this year started, many would have thought it won't be a good year for bonds. It's going to finally happen. And here we are again, another great year.
It's been a fabulous year for the bond market, and it shows the wisdom of trying to avoid market timing the diversification benefits of bonds. Many saw in the fourth quarter of last year, when it took a hit in their equities and their credit, the benefits of bonds. Now here at these yields, investors will say, isn't it risky now? Isn't it likely yields to rise?
Sub 2% at as low as we've seen since 2016 on the yield on the 10-year?
And it wouldn't take much of a rise, call it into the 220s, to erase all of the yield in a year. Small price losses would erase all of that. But there is this so-called positive convexity in bonds, where yields could collapse towards 0% in a recession, because the Federal Reserve more than likely will commit to keeping its policy rate low until the jobs rate falls back, when it rises again toward the 4% level it considers full employment. That could take up to 5 years before that happens and inflation rises. So in other words, the Fed's policy rate will probably be around zero for up to 5 years after a recession hits. And so this will mean the bond market will pin most yields out to 5 years near zero and other yields close to it. And so there's still a lot of room for U.S. Treasury yields to decline. But again, don't try to market time the diversification benefits of bonds. It's very risky considering the other components in an investment portfolio.